The ASX 200 closed down 0.65% on Monday. 8 of the 10 stocks responsible for the index's worst losses since late February are among the market's 20 largest companies, and yet investors keep piling into exactly those same stocks. In just 4 months, the combined weight of the 10 largest names on the S&P ASX 200 has jumped from 45.6% to 49.2%. That is faster than during COVID-19, faster than the first 4 months of the GFC. BHP and Goodman Group are each down nearly 14% since the war began. National Australia Bank has shed 16%. The index itself has fallen 8%. And the concentration is still accelerating. The question is not why the market is falling. The question is, who keeps buying the stocks that are doing the most damage? The answer sits in the $2 trillion sitting inside Australia's compulsory superannuation system. When geopolitical risk spikes, as it has since the Middle East conflict escalated in late February, super funds and passive managers face a structural compulsion. They do not sell and move to cash. They rebalance into liquidity. The largest, most tradable stocks on the ASX are the only ones they can move billions through without moving the price against themselves. Van Eck's Arian Nairon flagged this on Monday, noting that traders are gravitating to the most liquid ASX stocks precisely because they can exit them fastest if conditions worsen further. Global X's Mark Jochum reported that industry superfund members are accelerating flows into international ETFs, precious metals, and thematic funds, trying to escape the very concentration their own funds are deepening in the domestic index. This is the feedback loop that retail investors rarely see. Super funds tracking the ASX 200 benchmark are forced to buy more of whatever is already large. As large stocks fall and passive inflows continue, those stocks' weights get repurchased to maintain benchmark alignment. The result, WiseTech Global at a 4-year low, Xero at a 4-year low, ProMedicus down 66% from its July peak, yet the 10 largest names collectively hold more of the index than at any point since the GFC crisis months.
The invisible actor here is not a rogue hedge fund or a central bank intervention. It is the mechanical weight of $2 trillion in retirement savings chained to a concentration benchmark during a war-driven flight to liquidity. The number to watch is 50%. If the top 10 names push past half the ASX 200's total weight, the index effectively becomes a 10-stock portfolio for most passive investors. At that point, a single earnings miss or credit event in one of those names does not just hurt holders of that stock, it moves the entire benchmark. The evidence points toward continued pressure on this threshold in the near term. Oil above $100 keeps recession fears elevated, which extends the flight to defensive and liquid large caps. The fuel excise debate, Treasurer Chalmers refusing Monday to rule out a cut, adds a fiscal inflation wildcard that makes the RBA's next move harder to read, and harder monetary policy sustains the same liquidity-seeking behavior in super funds. The recovery scenario requires one of two triggers. Either oil falls back below $90, releasing the geopolitical risk premium and allowing super funds to rebalance into mid- and small-cap names, or the RBA explicitly signals rate cuts, which would reopen risk appetite and broaden buying across the index. Neither is close at the current moment. The benchmark to check tomorrow is the ASX 200 sector breadth, specifically whether the energy and materials indices can sustain gains without the financials and technology sectors dragging the headline number lower. If breadth continues to narrow while the index holds, the 10-stock concentration will reach 50% before the end of April. The one scenario that invalidates this entirely, a ceasefire announcement that sends Brent back below $90 overnight, that would be the fastest way to break the loop and the fastest way to prove that everything holding the concentration in place was borrowed time.